Okay. Liquidity is the amount of money you have in hand. Okay. And it also involves converting certain securities or assets into money. Okay. What is the importance of liquidity for a business? Why does a business need to be liquid? Why would you not invest in a business that is not liquid? And the answer is just what you have thought. What has come in your mind, that's the correct answer. So you just say it. Yes. What's the what is the importance of liquidity? So your answers, your answers, break them down. You need. Mm-hmm. Yes. So liquidity. Yes. So we can simply say liquidity is important for operational purposes for the business. Okay. The business, there are things you need to pay. Okay. Now, if the business doesn't have money on hand, is that's a problem because now to make the business has to now start getting loans, okay, and getting loans just to pay for things which they could have paid for themselves is not good, right? So liquidity, cash on hand, or the ability to pay for debts or liabilities when they fall due, okay, and if a certain asset or security can easily be converted into cash, we call that very liquid. If something cannot be easily converted into cash, then it's not that liquid. So our liquidity ratios, we've got the current ratio. Okay. Or for those who are not there last time, this is the question we're looking at is this one here. Okay, this company here. I think I sent the did I send this document in the group? I'll resend it. Yes. It's we're looking at this company here. Okay. VAG Limited. Yes. So the first liquidity ratio, colleagues, is what we call the current ratio. Okay. The current ratio, you're comparing your current assets with your current liabilities. In simple terms, what the current ratio is trying to find out is can you cover your current liabilities with your current assets? Okay, colleagues? That's what the current ratio is trying to find out. Can you cover your current liabilities with your current assets? And if you can, that is very good. And there should be some change even left over. Okay, and what do we call that change? When you subtract current assets minus current liabilities, what do we call that change? Do we remember the term working capital? When you subtract your current assets minus current liabilities, the remaining money that remains there, that's what's called your working capital. Okay, working capital is just the money used for the day to day running of the business. Okay, so the current ratio, if your current ratio is less than one, it means your company has got liquidity problems. Okay, if your current ratio is less than one, your company has liquidity problems. It means it cannot cover all the current liabilities with its current assets, which is a bad thing. Okay. Then, if your current ratio is greater than one, Okay, you always want the current ratio above one. It means you can cover your current liabilities with your current assets. Okay, colleagues. So for this company, I hope we remember current assets and the current liabilities, right? Current assets, cash, what else? Stock, what else? Cash at bank, what else? Receivables or debtors, yes, okay. And even short-term marketable securities. Colleagues, what are the examples of these short-term marketable securities which are found in the money market? Treasury bills, yes. The company can buy treasury bills. Okay, they can mature within 6 months. Okay, so once it matures, you get your money back and you can use it. Or if you want, you can even sell that same treasury bill so that you get money to use for your business. Okay, so also short-term marketable securities for under current assets. Okay, so for this company here, VAG Limited, okay, because with ratios, you're always comparing two different years. All right, two different years. So we're going to do for 2022. We look for our current assets here. They've told us in the question here. Current assets. Here we go. We've got our current assets. Receivables, inventory. Okay, these are our current assets here. All right. Then current liabilities. Colleagues, which current liabilities can we see here? In this list here, which current liabilities can we see? Yes. What else? Colleagues. Here it's even written for you current liabilities there. Dividends payable. What's the definition of a current liability? Yes, something which you have to pay within a year, basically. Okay, what you have to pay within a year. Okay, so I already did calculations on this. Okay, so we just look at the calculations here. Mm-hmm. Um, what is the caption? Yeah. Uh, yes. What do you mean carry forward, sir? Hmm. They're assuming these can be probably other current assets apart from receivables and inventory. Sometimes they like to do yes, yes. So if you ever confronted with such a question, it won't be advisable you just use this value and ignore these other ones. Okay. So we always remember what the current assets are, the current liabilities, so that should he bring a question where the balance, the income statement writes current assets, and you find inventory and other things there. Remember, since you know that inventory is a current asset, include it. Okay. Yes. So for 2022, the current ratio is 1.726. Okay. 1.726. Basically, you can interpret it like this company can pay its current liabilities 1.7 times with its current assets. It can pay its current liabilities 1.7 times with its current assets. Okay. Or if you round off to 2, since 1.7, you can also round it off to 2, a whole number. You can say it can pay its current liabilities 2 times. But here, I wouldn't advise rounding it off yet. Okay. But since it's above 1, it's a good signal. What it's telling us is that it's got more current assets than current liabilities. And it can cover its current liabilities with its current assets 1.7 times. Any questions? Then in 2021, its current ratio was 1.99. Okay. It's 1.99. Okay. So this one is the one which you can also, one you can actually round off to 2. Okay. So in 2021, it can this company can cover its current liabilities 1.9 times with its current assets. Okay. So if you're asked to comment on something like this, what can you comment, colleagues? In 2021, the current ratio was 1.9. In 2022, it's now 1.7. What comment can you make about this? You can say slightly more because the difference is just by zero point 0.2. Okay. So it had slightly more. But in the overall scheme of things, it's almost like the company is almost like still, it just lost, is still in the same position. Okay. Because a difference of zero point 0.2 is not a big change. Okay. It's not really a big change. Okay. You don't even need to get very worried. You see a drop by just by zero point 0.2. Where you can get worried is the here 1.9, then in the next year you find something like 1 or 0 point something, then there you see a problem there. Okay. But in this case, overall, this company is still doing good. Its current ratio is above 1 for both years, meaning it's liquid enough. It can cover its current assets, its current liabilities, and it has got some working capital. Any questions before we go to the quick ratio? Okay, you've got your quick ratio. Okay, so here we're asking if we can take care of our current liabilities with our quick current assets, meaning the current assets that we can easily convert into cash. Okay. So in the quick ratio, we exclude inventory and prepayments. Okay. We exclude inventory is treated as the least liquid current asset. That's why it's excluded here. The least liquid current asset. Okay. So just like the current ratio, this quick ratio is just finding out, can you take care of your current liabilities with your most liquid current assets? So the formula is the same, but you just say current assets minus inventory. Okay. The current ratio was just current assets over current liabilities, but here it's current assets minus inventory over your current liabilities. Okay. So for this company here, okay, in 2022, the quick ratio was 1.457, which means yes, it can take care of its current liabilities with its most liquid assets, which is a good sign. Okay. The company doesn't basically need to sell inventory to take care of the current liabilities. They've got enough cash on hand, trade receivables, marketable securities that they can use to pay off their current liabilities. Okay. Then in 2021, we had the current ratio of 1.68. Okay. So again, we've seen there's a minor drop from 2021 to 2022. There's a minor drop. Okay. There is a minor drop. But all in all, for this company, they are in a good position because they can take care of their current assets with their current liabilities. Any questions? Okay. There's also the cash ratio. It's just that in this question, there was no cash. The cash ratio is just your cash. Can you take care of your current liabilities with your cash? It's just your cash at hand, cash at bank, and also marketable securities. Okay, cash plus marketable securities over current liabilities. This one shows if you can take care of your current liabilities solely with your cash and marketable securities. Okay. And if your cash ratio is also above one, it means it's a very good thing. Okay. If it's below one, it can be expected. Even quick ratios. Quick ratios, it's not all the time you get them above one. Huh? Okay. Hip hop and hopping. I mean, oh, let me get bundles. Where was I kicked out? I was kicked out by networks. So where was I kicked out from? Okay. Yes, cash ratio, if you can cover your current liabilities with your cash. Okay. So liquidity ratios basically is those three. Okay. You've also got this one, sales to working capital ratio. Okay. This ratio, you're trying to see how a company utilizes its working capital to generate sales. Okay. Remember, working capital, it's the money used for the day-to-day running of the business. Okay. So this sales to working capital ratio is just your sales revenue divided by your working capital. Sales revenue divided by working capital is current assets minus current liabilities. Okay. So 74,521 divided by 16,200, you get 4.6. Okay. Sales to working capital ratio. Sales to working capital ratio. The ability of a company to generate sales from its working capital. Okay. Is the company efficiently using its working capital to generate sales? So this 4.6, the way we can translate it is for every one kwacha invested in working capital, we generate 4.6 kwacha in sales revenue. Okay. That's how you can read this sales to working capital ratio. Every one kwacha invested in working capital, we generate 4.6 kwacha in sales revenue. As I said, this sales to working capital ratio, you just want to see how well are we utilizing our working capital to generate sales. Okay. For 2021, sales to working capital ratio is 3.49. So for every one kwacha invested in working capital, the company generates 3.49 in revenue. So it seems we did better in 2022. We are generating more revenue from our working capital as compared to 2021. Any questions? Before we go to leverage ratios and gearing ratios. Okay, leverage is how much debt a company uses. Gearing is or comparing the debt to equity financing. Okay, debt versus equity financing. Okay, this is what these ratios are talking about. When you're investing in a company, it's better. Remember, equity is, think of equity as the owner's own financing, then debt financing is other people's money. So when we're analyzing especially these gearing ratios, it is more attractive if a company is using more of its own money, equity financing, versus other people's money, debt financing. Okay. Because the thing about the debt financing is the more debt financing you use, the more interest payments you have to pay up. Okay. Debt financing is okay, but don't overuse it also because excuse me, unlike equity financing where at times you don't need to pay the shareholders their dividends. With debt financing, you always have to pay the lenders their money. Okay. So the first one we can look at is the debt to equity ratio. Okay, debt to equity ratio. We're comparing debt and equity financing. So in 2022, this company had 14,000 kwacha of debt financing and 39,900 in equity financing. Okay. So basically, if we divide the debt, and we do this, debt divided by equity, 14,000 divided by 39,900. Okay. You get 0.35. Okay. So what this means is for every 1 kwacha of equity, there is a 35 ngwe of debt. For every 1 kwacha of equity, there's 35 ngwe of debt. Meaning you are using more equity financing compared to your debt financing, which is a good thing because you're using the owner's money of the company. Equity is just ownership. Okay. Compare it with 2021, we see so if you do debt divided by equity, 17,500 divided by 35,087 kwacha, get here we got 0.49. So for every 1 kwacha of equity financing, there's 49 ngwe of debt. Or we are using 49 ngwe of debt. Okay. So basically, when we get our financing, you get a 1 kwacha of equity and you get a 49 ngwe of debt. Meaning you are using more equity financing as compared to debt. Any questions? Equity ratio. How much of the firm's assets are financed by the owner's equity? Where it's just equity over assets. Okay. The equity in the question there is the where they said shareholders thing. Shareholders funds, this is the equity. Shareholders, owners of the company. So now with this equity ratio, we want to find out the assets that we buy for this company. How much of that, how much of the financing of the assets comes from equity? Okay. So equity divided by assets. In the question there, you get current assets, non-current assets. Okay, that's why I got all these figures, current assets and non-current assets. Okay. Sorry, I forgot to mention this. So this one's what we're looking at before is the debt to equity ratio. Okay. Yes. Now we're only the equity ratio. Then the debt ratio is also the same. How much of your assets are financed by debt? Okay. Yes. So here, when we add all the assets together, we get 76,200. Equity 39,900. We divide the two, we get 0.5. So what that 0.5 tells us is that for every one kwacha we use to purchase assets, 50 ongwe or comes from equity, then the other 50 ngwe should come from debt or other sources apart from debt. I wouldn't just say 50, the other 50 just strictly debt, from other sources. Then for 2021, okay, we had an equity ratio of 0.49. So for every one kwacha used to purchase assets, 49 ngwe came from equity. So this company, it's not, it's the drops are minimum, okay? The drops, but yet there was an increase. 2021 it was 0.49, 2022 it became 0.5. So that's just a small increment, which I wouldn't say is very material. It's a very small increment. Okay. But overall, it's like almost 50% of our financing from assets is coming from equity. Okay, this 15 ngwe is like half of one kwacha. 49 ngwe is next, nearly half of one kwacha. So basically for this company, we can say on average, 50% of the asset financing is coming from equity. Next, we have the debt ratio. How much of the firm's assets are financed by debt? Okay, so here's just debt over assets. Okay, so in 2022, 0.18. So for every one kwacha used to finance or purchase assets, 18 ngwe comes from debt. Okay, 18 ngwe comes from debt, 50 ngwe comes from equity, then the remainder comes from another source. And as our equity to debt ratio was telling us, we're using more equity than debt in this company. So we expect our debt ratios to be low. Okay. Then in 2021, it was 0.24. So for every one kwacha used to finance or purchase assets, 24 ngwe was coming from debt. So it's like in 2021, we reduced, when we moved from 2021 to 2022, we dropped from 24 ngwe to 18 ngwe. Okay. So we are using less debt to finance our assets in 2022 as compared to 2021. So as an investor who's making up a portfolio, you would want a company that is using more equity financing. Okay, because with equity financing, there's no those risks of the interest payments where you'll be owing money and you need to pay people. No, it's the owner's finance. Just like a business, a sole trader. Okay, if you want to support someone who's a sole trade and you ask them, are you using more of your own money or are you using borrowed money to run your business? If the sole trader tells you I'm using more borrowed money to run my business, would you want to fund him? Madam Namakao, Madam Tandewe. Madam Mary. Okay, a relative comes. I'm running a sole trader business. I'm asking for you to fund my business. And then you ask them, okay, which type of financing are you relying most? Let's say two relatives come. One tells you I'm using more debt financing to run my business. And another comes, I'm using more of my money to run the business. Who are you going to be more inclined to invest in? Mhm. So even yes, no, that's correct. Yes. So even the same applies to companies. Okay, a company that's using more debt financing, there are a lot of risks attached to that. They have to pay back that debt. So there's a risk that they might default. Now, a company that's using equity financing, even though they default with the ordinary shareholders, so long as they're still making money. So you would want to work with a company that's using more their equity financing. Next, you've got these shareholder ratios. Divi- Okay. The first one is the dividend per share. Okay. For each share, how much dividends is the shareholder supposed to get? Okay. So you get the total dividends divided by the number of shares. Okay. So in 2022, 4,000 total dividends was 4,800. Number of shares 14,000. So each shareholder was getting 34 ingwe. From the total dividends, each shareholder is getting 34 ingwe. Okay. In 2021, the dividend per share is 0.22 ngwe. So it's meaning each shareholder is getting 22 ngwe. So as someone who's compiling a portfolio, you see one company is paying more dividends than the other company. Which one are you going to be likely to purchase shares in? Just hold on. Yes, colleagues. Yeah, you're compiling a portfolio, and you see one company is paying. Here we pretend that these are two companies. One company is paying each 34 ngwe per share. The other one's paying 22 ngwe per share. Which company will you most likely invest in? Madam Tandiwe? Remember, no answer is wrong. Yes, that's correct. The one that's paying more dividends. Because when you're forming a portfolio and you buy shares in that company, you'll be expecting to make you want more dividends for the people's money that have. Sir, could you kindly mute your mic? Yes. So the company that's paying more dividends, you're going to be inclined to purchase shares in there. Okay. Because remember, when you're making this portfolio, it's for somebody. Okay. So you would want to get a company that's paying more dividends to its shareholders. Okay? Then you've got your dividend coverage ratio. Basically, it's asking how many times can a company pay dividends with its profit after tax. Okay. You want to know with the profit after tax which the company makes, how many times can they pay their shareholders dividends? Okay. So it's just dividend coverage ratio, it's just your profit after tax divided by the total dividends. Okay. So in 2022, our dividend coverage ratio was 1.8. Okay, so in 2022, this company can pay off the dividends 1.8 times in a year. Okay. If we round it off, okay, but to these ratios, I wouldn't say rounding off. Okay. Then in 2021, dividend coverage ratio, profit after tax divided by total dividends, 2.55. So in 2021, this company could pay off the dividends 2.5 times in a year. Okay. This dividend coverage ratio doesn't mean that the company will pay two times. No, it's just saying that okay, if they had the ability to pay out all this profit as dividends, how many times can they pay it in a year? Okay. So in 2021, they could pay off more dividends in a year than 2022. So we come back to the question as someone who's forming a portfolio, company A can pay dividends. Let's use whole numbers this time. Company A can pay dividends once in a year, and then company B can pay dividends twice in a year. Which company are you going to be inclined to invest in? I would be more likely to invest the one that can pay two times in a year. It means it's got a lot of profits. It's making more profits. Okay, so it can the dividends the shareholders can be if the company wanted the shareholders can be paid twice. Okay. Yes. But remember, this one is just a signal. It doesn't mean that because you find one company you can pay twice in a year, the other one pays once. Then you find the one that can pay twice doesn't even pay dividends at all that year. Yes. Because remember, these companies, this profit, they can reinvest it into other things. Okay, they can tell the shareholders, wait, want to reinvest this. Okay? So this is just more like a signal. Okay. That's why being a portfolio manager is very tough because these ratios, they are just, how can I say?